Hello and welcome to Quartic. This is episode 9 in our series, CFA Level I, 10 Topics in 10 Weeks. The topic for this week, topic number 9, is alternatives, which makes up 6% of the Level 1 exam. Now there's just one reading here, Introduction to Alternative Investments. Alternative investments refer to investments other than traditional shares and bonds. The reading actually covers 5 alternative investments, namely hedge funds, private equity, real estate, commodities, and infrastructure. Alternatives can also refer to alternative methods for investing, so using leverage, taking short positions, or even purchasing illiquid assets. Now, in terms of this reading, you will need to become familiar with the characteristics of alternative investments in relation to other traditional asset classes like shares and bonds. Things like low liquidity, low correlation, lighter regulations, low diversification, high fees, and redemption restrictions. Then you spend your time going through each of the 5 investments presented in the reading. In relation to hedge funds, know that they are private investment vehicles that take on high-risk strategies. Know that they're usually structured as limited liability partnerships, where the limited partners are the investors and the general partners manage the fund. Know the briefest definition of the various hedge fund strategies and which categories they fall into. For example, event-driven, relative value, macro, and equity hedge strategies. Be familiar with the manner in which fees are quoted, so be able to calculate incentive fees, management fees, and overall returns with or without a hurdle rate. Note that some funds report 2 net asset values, a reporting net asset value based on quoted prices, and then a trading net asset value discounted because of the illiquidity of the fund's assets. Also know that redemptions are usually restricted and investors may be subject to a lock-up period, in which case no redemptions can be made, or a notice period of a few months if redemptions are required. In terms of private equity, know the basic features of both venture capital and leveraged buyouts. Remember, traditionally, private equity companies invested in unlisted companies. Know that private equity firms, just like hedge funds, can also be structured as limited partnerships, where the limited partners are the investors. Know that committed capital represents the contributions of investors, whereas drawn down capital is what has been used by the firm for investing in their portfolio companies. Note specifically that management fees are charged on committed capital, and also that general partners can charge incentive fees based on profits. Be familiar with the benefits and risks of investing in private equity, as well as exit strategies that these firms may use, so things like a trade sale or a secondary sale. In terms of real estate, know the categories of real estate, including private, public, equity, debt. Describe the broad features of a residential and commercial real estate. Know about real estate investment trusts and also mortgage-backed securities. In addition, be familiar with the 3 valuation methods. So the comparable sales approach, that looks at similar properties sold recently and it adjusts for factors such as age, size, and condition. The next is the income approach, which takes net operating income and divides by the cap rate. And finally, the cost approach, in which the value of the property is calculated by looking at the cost of the land plus the depreciated replacement cost. Be aware of the 3 categories of real estate indexes, including appraisal indexes, repeat sales indexes, those are subject to sample selection bias, and finally, real estate investment trust or REIT indexes. With commodities, know the methods for investing in commodities and the basics of spot or futures pricing. Also know that commodities have low correlations with other asset classes and are a very good inflation hedge. And finally, with infrastructure, know the difference between economic and social infrastructure. So transportation, utilities, for example, would be categorized as economic, but education and healthcare would be social. Also know the difference between brownfield and greenfield investments. Think of brownfield as existing assets, so the refurbishment of a train station, but greenfield as new, so building a new hospital. Note that brownfield investments have lower risks generally than greenfield. A great deal of what is covered here at level 1 in terms of alternatives will feature again at level 2, so it is worth investing the time. And overall, the questions in the exam are actually quite straightforward. So that is it for this week. Thank you very much for watching. For free access to Quartic Online, please get in touch by using the details on the screen. Also, follow us on Twitter @Quartic Training for access to more videos and useful resources.